Today we are covering the rules for non-cash charitable contributions, a frequently tested topic on the enrolled agent exam. The key to these questions is knowing how to value the donated property, which depends on its type. Let's start with capital gain property versus ordinary income property. For long-term capital gain property, like stock held for more than a year, the taxpayer generally gets to deduct the fair market value. An exam question might state a client donates stock with a fair market value of $10,000 and a basis of $2,000. If their AGI is $100,000, the deduction is the full $10,000 as it falls under the 30% of AGI limit for this type of contribution. A common exam trap is to provide the same facts, but state the stock was held for only 11 months. This makes it short-term capital gain property, which is treated like ordinary income property. For ordinary income property, such as inventory from a business or that short-term stock, the deduction is limited to the lesser of the property's basis or its fair market value. So, for that stock held for 11 months, the deduction would only be its basis of $2,000, not the $10,000 fair market value. The exam also loves to test specific property types, especially vehicles. When a taxpayer donates a car, the deduction is usually limited to the gross proceeds the charity receives from selling it. The charity must provide the donor with Form 1098-C showing this amount. A classic exam question will give you the car's Blue Book value, say $4,000, but state the charity sold it for $2,500. The taxpayer's deduction is limited to that $2,500 sale price. The trick is ignoring the higher fair market value unless a specific exception applies, such as the charity making significant use of the vehicle in its operations. For donations of clothing and household items, the critical phrase to remember is good used condition or better. Expect a question where a taxpayer donates a large amount of clothing that is described as being in poor, unusable condition. In that case, no deduction is allowed, regardless of the quantity. Finally, you must know the reporting and appraisal thresholds, because they are easy points on the exam. If a taxpayer's total deduction for all non-cash contributions for the year is more than $500, they must file Form 8283. The exam will test this exact threshold. For example, if a client donates a painting worth $600, Form 8283 is required. The rules get stricter for higher value items. A qualified appraisal is required for any single item or a group of similar items valued at more than $5,000. An exam question might describe a donation of artwork valued at $10,000 without mentioning an appraisal. The correct answer would be that the deduction is disallowed without that qualified appraisal. A simple phrase to remember these key thresholds is, over 500, the form is due. Over 5K, an appraiser sees it through. This helps keep the two most critical reporting numbers separate, preventing confusion between the Form 8283 filing requirement and the much stricter appraisal requirement for high-value donations. Remembering these distinctions is essential for success.